If you are a property developer in Kenya and you collect deposits from buyers before the projects are complete, KRA may look at your bank statements, and when they see money coming in, they may treat all that money that is coming in as taxable the minute it enters your account. So if you sell land on installments, let me ask you, are those installments taxable? I want to show you a case where the Tax Appeals Tribunal looked at that argument carefully, examined the law, and it looks at international accounting standards and said clearly, and they said this on record, that the KRA would be wrong to tax your deposits the minute they hit the account. When the tribunal decided that, the questions becomes, when are off-plan deposits taxable? This is very important for developers who are collecting millions of shillings in deposits before even the first unit is ready for occupation. And this is important because the timing of that revenue is the difference between a profitable project for you as a developer and a tax bill that wipes out all your entire profit even before a single buyer has moved into the development that you are putting up. By the end of this video, you will understand what must be done before all these deposits become taxable. We'll also go through what evidence you need for you to be able to defend your position if KRA comes calling. And now, let's start building. Longonot Gate Developers Limited had a piece of land in Naivasha, and they had a great vision. They wanted to turn this piece of land into serviced plots. These are individual plots where, when you're selling the plots, you don't take a big chunk of land, subdivide it, pave it, put roads within the estate, and then what Longonot Gate developers wanted is to give all the buyers 99 years leases. So they went ahead and put up the infrastructure, which was completed by the end of August 2015. But selling started in 2011. So around 2011, the buyers wanted to secure plots, signed agreements, and started paying deposits from 2011. And by the end of 2011, the total deposits that had been done were around 600 million. But for Longonot Gate, they did not treat all this money that was coming in as taxable income. They recorded this money in their books as a liability. And a liability is something that is payable back. Now, they did this because the deposits were refundable under all the agreements that the buyers signed. It's the same case for us, because we also sell land, which you can be able to pay in installments, and we give you an agreement that says your deposit is refundable. And we have several properties on Kamudo Road, so be sure to check them out. But let's go back to the case. If Longonot Gate failed to deliver service plots, then everything would have to be refunded to the buyers, minus a small fee for administration, of course. To KRA, this wasn't what they had in mind. That is why, on a cold July 28, 2014, KRA sent them a demand letter saying all the deposits that had been received in 2011 were taxable income for the year 2011. The total tax demand, including penalties and interest accumulated over time, was 185 million. Now, when Longonot Gate looked at this request from KRA, they realized this would wipe away all the profits that it was intending to get. So they did what every sane developer would do. They raised their hand and said the magical word, I object. But when they did this one, KRA was not impressed. KRA stood firm, and they argued that all the deposits that had been made were payment for the use or occupation of the property, and that the price of each plot was one. The price of each plot was known. Second, the cost to develop each of the plot had been charged as expenses already by the company. Now, Longonot Gate couldn't take this decision, and that is why they took the matter to the Tax Appeals Tribunal. Before the tribunal, Longonot Gate made a very clear and a very well-documented argument. They pointed to international accounting standards, and in this case, IS 18, which governs how you recognize revenue. Under IS 18, income should only be recognized when 5 conditions are all satisfied. And in this case, they had not been satisfied. Let us go through all these conditions at once. First, the first condition is the seller should have transferred all the main risks and rewards of ownership to the buyer. That's the first one. Secondly, the seller should no longer have any control over the property that they are trying to sell. And thirdly, the amount of income should be able to be measured reliably. And additionally, it should be very possible that all the economic benefits have flow or will flow to the seller. And finally, all the cost of the transaction should be able to be measured reliably. And I know the argument is valid because you also think it is. And as my good follower, you already understand a lot about taxation, so I know it was easy for you to get all those 5 points. The company argued that in 2011, when all these deposits were being received, none of the 5 conditions had been met. First, the infrastructure had not been built. Secondly, no single plot had been handed over to any of the buyers. And not only that, for long or not gate, they still realized they are still in control of all the plots of land that had been purchased entirely. And most important, all the deposits that had been paid were still refundable. And for them to show that all these deposits were still refundable, they were able to prove 3 people who had purchased the plots and they requested for their deposit back, and they were able to get all their deposits minus again a small administrative fee. When KRA had this, they questioned the company's witness. So the accountant was there. And here is the question from KRA. 1. Is a deposit not part of the purchase price? Which the person responded, yes. Second, is a deposit then not income? The witness said no. And he explained that for it to be considered income, the income must be earned. And in this case, the company had not earned anything yet because the plots did not exist as finished service products. In their eyes, the taxman was defeated, but like a drowning person, they found a reason to keep afloat because they argued one more point. KRA then suggested that construction companies sometimes create shell companies to be able to avoid their tax liability. But this time, the company employee stayed silent and he left the battle to the tribunal. And the tribunal came in. They explained, like you'd explain to a 2-year-old, that speculation about tax avoidance is not evidence of tax avoidance. KRA needed to focus on items of the law and not speculation. The company's lawyer then introduced a very famous Australian case, and this is Atamore versus Commissioner of Taxation. This case was from around 1965. The case involved a dancing school that was taking fees for lessons that were going to be delivered later. For the few of you who haven't left the country or even owned a passport, let me take you not just outside the country, but outside to a new continent as well. The Australian Tax Authority, in that case, wanted to tax these fees from the dancers immediately. But the Australian court said no. The lessons had not been taught. The students could still ask for refunds, and if they did, the refunds should be given. And for that reason, the income had not been earned yet. The tribunal, in our case, found the Australian case really applicable to the Kenyan case as well. Rogonot gate deposits were for plots that did not yet exist as finished products. If the company, in this case Rogonot Gate, stopped operating at all the deposits that had been collected would be refunded. And if this is the case, taxing all these deposits in 2011 would be taxing income at the wrong time. And the tribunal wasn't done. They also rejected KRA use of its own internal policy manual as a basis of making an assessment. The tribunal correctly said an internal guideline from KRA does not form part of the law. Because if Parliament had wanted to tax refundable deposits whenever someone receives them, it would have said so in the Income Tax Act. And currently, it does not. The sections that KRA were relying on did not apply in this case because no buyer was either using the plots, no buyer was building on the plots because all they had done was pay the deposits. That is why in December 2016, as President Uhuru Kenyatta directed the official registration and naturalization of the Makonde people, the tribunal delivered the judgment. And the judgment was the deposits were not taxable for the income year where it was received. Additionally, the related cost could not be moved from the balance sheet to the income statement for them to be taxed. And due to that, the original assessment from KRA was cancelled. The country suffered as thousands of health workers across public institutions boycotted work Longo not celebrated, but they celebrated for a good cause. This is because they had won a case which was able to set a local precedent as well. And because of this, let me give you the lessons from this case. First, if you're a property developer in Kenya and you're collecting deposits on off-plan projects, here is what this particular case establishes. First, it establishes that refundable deposits on either units you are putting up for sale or plots that have not yet been completed during the process of either upgrading a few items here and there, and they haven't been transferred to buyers, any money received cannot be treated as taxable income whenever you receive it. For you to be able to recognize any revenue under Kenyan law, you have to align to international accounting standards, and these accounting standards require that the risk and reward of ownership should have been transferred to the buyer before that piece of income is recognized. This case also establishes that a deposit collected today on a unit, let's say it's offline, that will be ready in 3 years, remains a liability to the company. That money received should not be treated as income, provided that deposit is genuinely refundable and the conditions to recognize that as revenue have not yet been met. But if deposits are not refundable, then they must be treated as income. And to defend this position, you will need to have several things in place. First, your sale agreements must clearly state that deposits are refundable in special circumstances, or identify a few. Secondly, you must be able to demonstrate that you have actually made refunds in cases where buyers have cancelled their agreements. Thirdly, your accounting records must clearly show those deposits as liabilities, so they need to be on your balance sheet. They should not be showing up as revenue in your profit and loss statement. Additionally, your revenue recognition policy must be very well documented, and it must also be applied consistently across different projects. And most critical, you must ensure that the process that you go through when objecting to a case from KRA is the right one that has been set in law. Because the Rama Home case in the previous video shows exactly what would happen when you as a developer, you encounter the same arguments, but you fail to follow the right procedure. For you over there, this is what you need to do. One, if you're a property developer who has received an assessment from KRA treating your off-plan deposits as income, or if you want to ensure that revenue recognition policy that you have is defensible before KRA comes knocking, you need to reach out to us. Next video, I'm going to tell you about the biggest infrastructure project in Kenya recent history. This is the SGR. A tax dispute came out of it. And the question in that dispute was whether a Chinese construction company was required to deduct and remit pay on allowances that it was paying to Kenya police officers who are guarding the construction site. And to give you a brief, the police officers were employed by the government. They weren't employees of the contractor. But KRA said that that did not matter. When KRA said that, the battle began. And for you to know how it ended, watch this video next.